It isn't. In fact, trading can be pretty simple and, dare I say, even easy. The problem is that trading has become way overcomplicated in the past couple of years. These, what I call the three-letter influencers, have pretty much overcomplicated trading to the point where nothing even makes sense anymore, and you can't even have a conversation with a trader without them spitting out 5 different abbreviations for something as simple as a bottom or a top, okay? Trading comes down to just a few things. One, of course, is, like I said, keeping it simple. The more you overcomplicate the trading, the more you're going to suck at it. That is just the truth. Ask any trader how complex their strategy is, and they're usually going to tell you it's not really that complex. The second thing is literally just knowing what is right. And in a sea of misinformation today, that is almost impossible. But for example, did you know that when we make a higher high, the probability of us making a higher low and then a new higher high is roughly around 60%. So that is just a fact. That is just how the markets move. 60% of the time, when you make a higher high, you're going to make a higher low and a new higher high. If you didn't know that information, then what would you do? You'd probably be a little bit of a worse trader. So it really comes down to keeping it simple and also just knowing the facts about trading. So in this video, I wanted to give you the facts about trading, the top lessons that I've learned over the past 12 years of trading literally everything under the sun, literally everything. And I wanted to give my best lessons to you, the things that helped me the most to become a consistently profitable trader. And if you don't believe me, you can just jump on to my live streams. I'm live every single day on this YouTube channel, trading live consistently in front of your very eyes. Okay, so I think you're gonna learn a lot from this video. If you do, make sure to smash up that like button and subscribe, and let's get into it. Now, the very first thing that you have to understand about trading is that technical analysis is technically bullshit, okay? What do I mean by that? Well, what I mean is that no indicator or tool or volume profile, no one thing is going to be the holy grail. It's going to be pretty much useless alone, okay? So really what you want to understand about trading is what even makes the markets move, okay? And in my opinion, at least, and what I have found success with, is that orders, of course, shocking, orders are what moves the market. You can't sit there and pretend that the market moves because of a trend line or because of a high or a low. The only way the market is going to move is if there are orders there to actually move the market. That's how it works. You put money into the market and that moves the market, right? That is literally what a market is, guys. So don't think that because we have broken a trend line, that means that we are automatically going to go in a certain direction. So when I say technical analysis is bullshit, what I mean is that really, the only thing that you should use technical analysis for is finding those orders. Where are the most orders likely going to be? And that's the basis of my entire strategy. If you've been watching for a long time, you already know where I'm going with this. But orders are what moves the market. And so we need to find those orders, and that is the only technical analysis that I do. And so how do we actually find these orders? Well, there are 2 main areas where I have found the most orders to be lying. The first is always going to be previous highs and previous lows. So previous highs are going to have orders resting there because, one, people think that there's going to be a double top, or they're putting their stop losses above those highs, right? And then previous lows. Why are we going to have orders at previous lows? Because that's where people think double bottoms are going to happen, right? People are buying at bottoms, or they have their stop loss there, right? If the market is falling down to their down to the low, they're thinking, where's my stop loss going to be safe? Probably right beneath this low. Okay, very simple concepts. If you know what liquidity is, this is that simple liquidity concept. Orders rest above highs and below lows. The second way we can kind of guess where orders are by finding imbalances in the chart, okay? So notice that I'm only using technical analysis really to mark out lows and highs as of right now. Now, the second thing that I do is I mark out imbalances, points in the chart where price has had a really sharp move. Why does that mean that there's going to be orders there? Because it takes money to move the markets. So if the market moves sharply from a single point, then you can assume that a lot of money was involved in that area, aka institutions or big traders. So you're going to want to be aware of these areas, okay? This is what we call supply and demand. So for example, we have this high right over here where we saw a little bit of a pause and then a massive continuation lower. This is what we call an area of supply. We saw a pause in the market and then a massive continuation, so a massive imbalance. This is balance right here because we're not moving, right? We're just kind of sitting there. We make 2 consolidation candles, so that is balance. What do you need to make balance imbalance? You need an imbalance, right? So we create that imbalance through massive sell orders, and the way that we see that with our own eyes is literally seeing that massive spike downward, okay, from a consolidation. So this is how you mark out an area of supply. This is where sell orders are likely to be. And look at how when price comes back to this area, we see a massive sell-off and continuation down to the lows. Now, an example of demand would be something like this. For example, you have a consolidation / indecision candle and then a massive move up and away from that area. So the balance was in this area, and this is the imbalance. Now we come back down into this area and we don't really hold it, but you can see that definitely there was a little bit of a reaction in that area, and we saw a little bit of a spike higher because guess what? There were likely orders sitting in that area of imbalance. Now this would be a counter trend trade, so obviously you wouldn't want to be buying there, but I'm literally just using this as an example. I have not even looked for any other examples. Matter of fact, let's go take a little tangent and go look at earlier today when I traded live. We're going to go to the 30-second chart. Okay, I took a short on the NASDAQ. Now, why did I take a short on the NASDAQ? Well, we had what I call an order zone. So what happens when you take the two concepts that I just told you about, right? We have liquidity sweeps and we have supply and demand, okay? These are the two concepts that allow you to guess, you are guessing where orders are going to be in the market. Now, there is a way to not guess, and if you're on my live streams, it's called Bookmap. I'll leave a link in the description down below. It literally shows you where orders are sitting, so that's what you use for confirmation. But so far, all you need to know is the only two forms of technical analysis that I have found to work the best is going to be liquidity sweeps with supply and demand, okay? Finding where those orders are. All right, so what I do is I combined liquidity sweeps with supply and demand, and those two, when they're next to each other, create what I call an order zone. Now, I'm not going to go fully into what an order zone is in this video, but I do have an entire free playlist down below and a course that you can check out on how to trade order zones. It's what I trade every single day. It's my full strategy. But here's an example of an order zone right here, okay? You have a level of supply, right? This is imbalance. Why? We have balance, a little bit of a consolidation, a green candle up higher, and then all of a sudden you get this massive move right down, okay? That is imbalance. Why? We were skyrocketing up. All of a sudden, the market pulls the freaking floor out of beneath it, and then we see a massive move lower. Okay, so this is an area where we have some imbalance. Now, there's also another area of imbalance right above that, which is on the 1 minute time frame, which is going to look something like this. It's a little bit of a bigger zone, okay? So that is another example of imbalance. Why? Consolidation, balance, and then massive move lower, imbalance. So imbalance from this region, that is our level of supply. This is where sell orders are going to be. Okay, so on stream today, I was going short in these areas. Why? Because we had two levels of supply, okay? Now, I don't just trade supply and I don't just trade demand either. I always need to see a level of liquidity as well. Why? Because I need the most amount of orders when I am looking for a trade, because that is the only thing that moves the market. So what I do is I combine both liquidity and supply and demand to create an area of confluence, or confluence, however you say it. And that is going to look something like this, okay? We have previous highs right here. That is going to act as liquidity. We have previous highs right here. That is going to act as liquidity. Orders are resting above that area. We even have these short-term highs right over here. So I start the day by shorting a little bit into here because we have a level of supply and a level of liquidity right at that level of supply. Then I short again right in here because we take out that liquidity up there. And then I short one more time, up here because we have a level of supply and we have just broken short-term highs. And then, of course, I confirmed it all on order book, which again, I'm not going to get into this video because this is supposed to be a quick video, but this is a real trade that I took live in front of many people, and it is a beautiful trade, okay? My average price was somewhere around here. You could say my stop loss was risking above the highs, and my target was pretty much the lows. So that's a 3R trade. So the first lesson is, don't waste your time looking at freaking Fibonacci sequence stuff. Don't look at double bottoms, double tops, cup and handles, inverse head and shoulders, whatever. If you can't answer the question, why does this strategy work? In my case, my strategy works because I know that orders are more than likely going to be in those areas. With a head and shoulders or with a trend line break, what are you doing? You're just guessing. You're just thinking, well, the trend is changing here because I drew a line, and so it must mean that it goes down. That's not going to work. All right, that's just not going to work. Okay, or I'm buying because I drew this line and it should bounce at this line. No, that's not what moves the market, okay? The only thing that moves markets are orders. If you're not in tune with orders or where orders are or where orders are likely going to be, then you're going to be, you're probably not going to be a very good trader, in my opinion. You just need to understand the basic market fundamentals of orders. Now, the second main lesson that I can share with you is stop focusing on your winners, okay? I know it sounds crazy. Why would I not focus on how much money I can make? I want to make $1,000 a day. I want to make $10,000 a day. That's my goal. I got to focus on it. Nope, you don't, okay? The only thing that a professional trader cares about is how much can they lose? How much is what are they risking and what can they make? But mainly, what are they risking? And what are the odds that that is going to happen, right? What are the odds that they're going to lose this amount of money? And how can you make it the smallest number possible? That is what every professional trader focuses on. Not how much can I make? How much will I make? What's my profit goal? No. So what you want to do instead is if you have, let's say, $10,000, okay? If you have a $10,000, let's say you have a $50,000 prop firm account, okay? You have a $50,000 prop firm account, and immediately most traders are going to say, wow, I have $50,000. Well, I just need to risk 1% of this and go for 2 to 1 risk to reward, and I'll make $1,000 right away, and then I'll be so close to my pay. No. Here's what you really have to focus on. I have $50,000. My max drawdown is $2,500 if you're using Apex Trader Funding or Take Profit Trader. At least I think those are the max drawdowns. So you can't lose this amount. If you lose this amount, you lose your account, right? So first, number one, you define your max risk, $2,500. Okay, now we have a number to work with. All right, now what we need to do is we want to come up with a number that we ensure does not allow us to blow up our account. Okay, what do I mean by that? Well, now you need to come up with an amount that you can risk comfortably per trade. Okay, so in this case, what I usually do is about 5% of this number here. Okay, so 5% of my max drawdown per trade. Okay, if you were trading the full 50K, you can say 1% per trade. Okay, so you risk 1% of this 50K per trade. Okay, but for prop firms, because this channel is mostly focused on futures and prop firms, I do 5% of 2,500. So that comes out to roughly $125 per trade. So here's the magic. If I ever come close to this number, wow, this is not going today. If I ever come close to hitting this number on any trade, I just close out of the trade. I just get out of the position. And it really does make a difference. Why does this work? Why do you hard limit your loss per trade, okay? The reason is because if you can keep your losses small. So for example, let's say, you lose 125 bucks on a trade, and then on the next trade, let's say you lose 50 bucks on the trade, and then the next trade you lose, another 50 bucks on the trade. So you get one max loss and 2 kind of small losers. Well, as long as you're not blowing up your account and you have good risk to reward, there's going to be a time where you're going to hit that 2 to 1 risk to reward ratio. So now what? You're going to make plus 250. And then let's say the next trade you hit a 1 to 1 risk to reward. Now you're going to make plus 125. And then let's say the next trade you even just scalp it out for a plus 50, okay? If you can just make sure that the math makes sense, okay, you're just never losing big. If you can always make sure you're never losing big, these numbers shouldn't be hard to hit over time as you learn from your losses, okay? So a big problem that new traders come into is that they just immediately start risking too much, and then they go on tilt and they blow up in their entire account, and then they don't learn anything. You don't learn anything from that. If you can just make sure that you're risking a small amount per trade, then the winning will happen eventually as you adjust your stop loss or your position sizing or whatever it may be. You're going to adjust over time. And if your issue is just losing constantly small amounts, you know that you just need to win bigger. or you know that you just need to change where you're putting your stop loss, and eventually the results will improve. And the other thing about risking small is that if you know, let's say for example, that you'll never let your day, right, your max loss per day, you know that you'll never let your biggest losing day be over $250. If you know that, and that's 10% of your max drawdown, then that makes trading super easy. Why? Because you literally know that you're not going to lose more than this amount. If you don't have this type of risk, if you don't have this risk set in place, you're going to be shaky the whole day, because what's going to happen? Oh, I'm getting scared. I'm gonna buy here. Oh, it's going against me. I'm gonna buy again. Oh my God, it's still dropping. I'm gonna double up over here. Oh my God, it's still dropping. I'm double, triple. And then what happens? It blows you up. Whereas instead, if you have that mental limit, right? What happens? I'm gonna buy here. All right, maybe I'll average in again. All right, it's gonna keep going. It's hit my max loss. I'm out. Right? I'm out there. Boom. And you never blow up your account. It literally won't happen because you have good risk management. So that's the next thing, is good risk management is the key to everything. Make sure you're risking as small as possible. If you watch my live streams, you know that I go to break evens very quickly because my main focus is not losing money. It's not making money. It is not losing money. If the price goes in my favor, then all I have to do, my job, all I have to do is make good decisions from there on out. Trail my stop loss. Don't just panic exit, right? Just hold for as long as I can. Just squeeze out as much profit as possible. And that's your only job, is literally don't lose big ever. Don't risk too much. And then when you're actually winning, just try to make sure you're maximizing those wins as much as you can by trailing your stop loss, by adding to your winners maybe, by making sure you have a good average position. Okay. Now, lastly, the thing that kills the most amount of traders is going to be over trading. Okay. You do not, what is the point of having a strategy if you're not going to use it, right? And if your strategy is to trade at every minute of every day that you think it's going to turn around, let me tell you something, that's not a strategy. The whole point of a strategy is having some kind of replicable, I don't know how to say that word, replicable situation that you've seen a million times, okay? The point of a strategy is to make sure that you have an idea of what can happen next. What are your options, right? Do you know where to actually enter, where you should, add if it's a winner, what makes it a good trade versus a bad trade? That's the point of a strategy, is a repeatable situation that you see happening over and over again in the markets. What most traders do is they come in with no strategy, and what they do is they go, all right, well, we just broke lows. It's a liquidity sweep. I think I'm going to buy here. And then it goes lower, and they're like, I'll just buy some more. It goes lower, and you know how it goes. They'll just blow up their account. Or they'll get a little bit of a pop, right? And they'll be like, I'm up some profit. Okay, well, I'll just sell here. I'll take my profit there. Well, what if in this situation, most of the time we go up to the next high, right? Well, then you're just going to be taking small profits and never really understand why the market is moving the way it is, okay? So if you watch my live streams, today I only took 2 real size trades, a short here and I think a long down here somewhere. Don't quote me on that, but I know at least there was one good setup today, one, and it was right here. And I took that one trade, and pretty much for the rest of the trading session, I was just taking trades for fun for the sake of the stream. But one serious setup was right here, and I hit it with my max size, my full size, okay? That is what real trading is waiting patiently for your setup, because you will know what the possibilities are when price reaches that point, right? So for example, like I marked out, I knew that we had highs here, right? Here, and I knew that we had supply up here. So I know that the odds are that we're either going to kind of chop around and then move lower, or we're going to blast through these levels. That's usually what happens. If the level starts holding, it usually will hold. If we just blast through the levels, like we kind of did right here, okay, we blasted through the first level, but then the second level came around, and that's the one that held, and I added there and got a better average position. And then the market did exactly what I expected it to do. And then what do? I know that when a level holds and when we make a lower low, which we were at a lower low, I know the target should be the latest or most recent previous low, right? Which was right here. Okay, so my trade was literally from up here to down here, and I took partials along the way, but in general, it did exactly what I expected it to do because I've seen it a million times. That is the point of a strategy. If I were to buy, let's say if I were to buy up here because we're breaking out of this high, I have never traded that type of strategy in my life. So why do I think that I'm going to outsmart the market and that I'm going to know exactly where it's going to go, where it's going to stop, and where I should put my stop loss in case it doesn't, right? I'm not going to know that because I haven't seen it a million times. It's a complete guessing game, okay? So trading is really, really, really not that hard. It can really be summarized into 3 simple lessons. Number 1 is know what moves the markets, and that is going to be orders. Orders move the market. Number 2 is risk small amounts and focus on risking those small amounts only and focus on not losing big. And number 3 is patience, waiting for your setup, because if you don't wait for your setup, you are literally just flipping a coin and guessing. So that's it for this video. Thank you guys so much for watching. If you enjoyed, smash up that like button and subscribe. If you want to learn more about order zones, there's a course down below as well as a free boot camp called the Simple Trader Boot Camp. It's the playlist on my YouTube channel. If you want the best prop firm discount codes, check out once again the link in the description down below. You get 40% off at Take Profit Trader with code SimpleTrader and 80% off at Apex Trader Funding with code ST. Let me know in the comments down below what is your biggest #1 lesson you've learned in trading, and I'll see you guys in the next one.